Hello and welcome to the Accredited Investors Only podcast presented by Accredited Life. I am your host, Peter Neal. We have a very exciting podcast planned for you today. I'm going to be interviewing RJ Burr from Panex, and he's going to be talking about oil and gas investing, a topic that I myself personally don't know a whole lot about, so I'm very excited for this conversation. And we're going to talk about a whole bunch of different stuff, but kind of give you like a little bit of an introduction on RJ. He is the third-generation producer of American Oil. So this is a family business. He was born in the industry. He was on an oil site before he could even walk. Isn't that fun? It was 3 months after graduating high school, he started his first partnership, and he never looked back. Today, he is the president and CEO of Panex, and his main focus is in the Gulf Coast. His companies have raised and deployed over $300 million in upstream development, and he's partnered with some of the largest oil and gas companies, namely Shell, BP, and Marathon, to develop several million barrels in reserves. So RJ is going to talk about the oil and gas business, the opportunities, some of the challenges in the space right now, and how they're getting through it, and some of the opportunities that are in the distance. We're going to talk a lot about the demand of oil and gas right now, and then how accredited investors can get involved. Like I said, you are listening to the Accredited Investors Only podcast presented by Accredited Life, where we teach accredited investors how to live, work, and invest as accredited investors. So, without further ado, let's get right into the interview and welcome RJ Burr to the show.
You're listening to the Accredited Investors Only podcast presented by Accredited Life.
All right, RJ, thanks for joining me today. So, it's a pleasure to have you on here. Let's we'll hop right into it. Like we were saying prior to hitting record here, oil and gas is something that's, I've certainly heard of it, but how it works and the opportunities available, all that kind of stuff are pretty new to me. So could you give me just kind of maybe let's start with you introducing yourself and your background a little bit, and then we'll get into that.
All right. Well, oil and gas, I was in a group here this weekend, and they asked me, it was an academic group. It's an area that I'm normally not involved in when it comes to I don't have a PhD, but they asked what was one of the biggest disappointments with the education system. And honestly, when I think about it, it's not educating the kids on the role that oil plays in their life. Most people have no idea. I showed them a slide this weekend of 150 products of the roughly 6,000 products made from 1 barrel of oil. And the crowd shocked. Most people have no idea. Toothpaste, makeup, cosmetics, plastics. I mean, if it's poly, it's oil. And the modern world was really built on a foundation of oil. It's created more wealth, it's created more upward mobility, and it's changed the human condition for the good more than any product or any resource we've ever used. And the lack of knowledge, general knowledge on it, is really shocking. And so when it comes to who I am and what I do, I'm in the oil and gas business. 4th generations, both sides of the family. This is all I've ever done. Some guys spend their life searching for their purpose. I knew mine at 7. That was the first time my dad took me to the field. When I saw that army of pump jacks, the horses that go up and down, when I saw those for the first time, I was hooked. I made my first sale 3 months out of high school, and that was 31 years ago. I haven't looked back. And really, when it comes to oil and knowing your background in real estate, the beauty is oil and real estate might not be brother and sister, but they are first cousins. There's really only a couple thousand feet separating your real estate from my real estate, and it's all based on the same thing: location, location, location. If you're not in the right spot, you can't make money. And so that's a lot of our investors, a lot of our investing partners are real estate investors because they are very similar. Now, where it's a little different, well, the tax benefits. In oil and gas, I truly believe they're the best tax benefits in the business. They're an above line deduction. I'm not a CPA. I'm just giving you a general rule of thumb. But typically, if an accredited investor puts $100,000 in a drilling program, Uncle Sam's going to pay for roughly a third of it. My partners start the deal playing on 65-cent dollars. And so if all I do is make them even, if all I do is get them their money back to them, I've made them 35% on their money in taxes. And so
I think that's one of those things where even for me, who I don't have a background in oil and gas and just know what I've heard through some conferences and things like that, I feel like most accredited investors with any background on alternative investing know that there's a lot of tax advantages in oil and gas.
Oh, absolutely. As I was telling you earlier, I was at CPAC earlier this year, and this kid from PBS comes up to me. And he goes, "Hey, you're the oil guy, aren't you?" And we engaged in a conversation, and one of the questions he asked me are you concerned about everybody attacking oil and them going after oil? I said, no, not really. Then it's all window dressing. I said, because the fact of the matter is, there is currently nothing on the market that can replace oil. It's not solar, it's not wind. And I don't like getting into arguments with people on climate debate. Everybody has their own belief about it. I don't believe it. I believe there's ulterior motives there, but that still doesn't change the fact that what they're wanting to pull off the market and replace it with, the replacement doesn't work. And so as long as they keep talking about it, let them keep talking about it. Now, if they do attack the tax benefits, that's my indicator. The minute they start going after the tax benefits, that's when they're truly attacking oil. Until that moment, it's all window dressing. But because I don't know of any politician who set their reelection campaign as the main focal point being the one that wrecked the world's economy, because that's what would happen. I mean, you remove oil and we go back to the Stone Age. I mean, yeah, and it's kind of crazy. You look at it, and, when you look at environmentals and you look at all the attacks, well, don't take my word for it. How does the civilization, ask scientists, how do they measure their level of technological advancement? It is measured by how much energy a civilization can harness and utilize. Well, if that's the scientific definition, what has been under attack for the last 70 years? Every energy supply we have, whether it be nuclear, whether it be coal, whether it be natural gas. For some reason, the hallmark of measuring a country's technological advancement has been under attack essentially since we've been using it. And then they offer solutions that don't work. Well, that doesn't make sense. It doesn't make sense for a politician to put themselves in a position to where you set this whole house of cards up to fail, and now you want us to elect you again to rebuild it. It didn't make sense to me until earlier this year. I was at another conference, and I was talking to a member of British Parliament, and we were having this exact conversation. And I said, it just doesn't make sense. I'm a little passionate, so it was after a little rant, but so I did my little rant. I said, it just doesn't make sense. And he looked at me and says, "Yeah, Jay, yeah, it does." He said, "If you know what they're trying to do." And then what he said to me was quite simple, but it really was profound, because it made me realize, oh my God, yeah, that's the only thing that checks every box. He looked at me and says, "Hey, you cannot control abundance. You can control scarcity."
Yeah. Wow.
And when you think about that, what else could it be? I'm not a rocket scientist. I'm not going to put motives on people, but if it walks like a duck, quacks like a duck, and swims like a duck, most likely it's a duck.
Sure.
And so you just look at everything going on. Now, how does that bode well for my partners? How does that bode well for the people that are in the oil business? Well, the first thing people need to realize is who the oil business is. If you go out to a random group of Americans and say, name an American oil company, I'd be willing to bet most of their minds go to Exxon or Chevron or a company like that.
Yeah.
When nothing could be further from the truth. 83% of your oil, 90% of your natural gas that's produced, and more than 90% of the wells that are drilled by roughly 9,000 independent producing oil companies that average 12 employees or less. That's the American oil industry. And so when you look at the crash that happened here a couple of years ago, it wasn't the majors that it hit. It was those mom and pop companies. Now, don't get me wrong. There are some large majors out there. There are some very impressive companies. but the majority of oil is produced by mom and pop companies. And so when that crash happened, it created an opportunity for people that know the industry to position themselves like you never had a chance to before. And that's exactly. Now, we didn't see COVID coming. If anybody tells you they saw COVID coming, they're lying to you.
Sure.
What we did see coming is, regardless of whether you like President Trump or not, that's irrelevant, because what he did by increasing our oil production like to the levels that we were producing, he changed the entire power structure of oil. For 70 years, OPEC has been basically the cheap bottle washer. All of a sudden, we're producing so much oil that they really didn't have a say in what prices were. And so really what we saw, for lack of a better term, is we saw an economic war being engaged against our shale industry. We saw Russia and Saudi Arabia. We saw them flooding the market with oil, pushing the prices down. We figured they'd try to push it to $40, $45 a barrel, because most of your shale companies are highly leveraged. Most of your shale companies need at least $50 a barrel to pay their bills. And so if they could push it to $40, $45 a barrel, all of a sudden, a lot of these shale companies are in trouble. And so really, that's the dynamic of what we saw coming. We thought it'd take 12 to 18 months to play out. And then all of a sudden, COVID came. And it took that 12 to 18 months, and they crunched it down to 30 days. And that culminated on April 20th when the markets crashed. And the effect and how it, I mean, you don't want to survive on somebody else's misery. However, they had just as many opportunities as we did to watch and see what was coming. And so what it did, the very first day when the market crashed, boom, that was your first wave of companies that were knocked out. Your younger companies, your companies were on shaky financial ground. For whatever reason, all of a sudden, boom, out of business, sign in their front window. Well, the next wave came a couple of months later. We sent everybody home for COVID. The companies that could pay their employees more than the government and get them back to the field, they're the ones that made it. The companies that couldn't, a lot of them didn't. And so you saw a clearing of the playing field like we had never seen before. And it created an acquisition opportunity. And when you go back and look through American history and string together all the crises and all the economic crashes, in every case, there's one or a group of people that come out of the other side looking like geniuses. And when you string their stories together, they really have two common factors they share. The first is when the crash happened, they were liquid. They had cash in hand and they could make a move. The second is when their opportunity presented itself, they had the courage to push their chips in the middle of the table and make a move. And so, we had several million locked up and ready to go. When the crash came, I tell my kids when they're playing ball, when something bad happens on the field, you get one moment. One moment. If you got to cuss, you got to kick the dirt, whatever you got to do in that one moment to get it out of your system. You got one moment to get it out of your system, then it's in the past and you don't think about it again. And so when that market crashed, we had a couple of partnerships that were hurt. Don't get me wrong. I mean, it hurt us too. Now, those partnerships will be fine. We've recovered. No, I'm not sweating them. However, we had our oh shucks moment. Well, once that oh shucks moment was passed, we kind of looked at each other and said, you know what? This is what we expected to happen anyway. And so when everybody else was kind of tightening their sails up and pulling them in to ride out the storm, we opened ours wide open and started making acquisitions. And from that point until today, we've made 23 different acquisitions. We've secured, we believe, about 100 million barrels in reserve. And really now all we're doing is developing.
Okay.
Generating our partners' revenue through. Okay, go ahead.
Talk to me about that, RJ. So for somebody new to the space, give me an idea of what it is exactly that you do.
Okay. What we do, let's just take the current field we're in. We're in the Choctaw Salt Dome. When you hear them talk about the Strategic Petroleum Reserve, that's our salt dome. We own the roughly 3,000 acres surrounding. And so we love salt domes. The reason we love salt domes, they're the oldest oil formations. They were really the original oil formations that your geologists back in the Wild West days of oil, they were the first ones they could identify. Well, being the oldest oil fields, a lot of the times they were developed longer ago than most of the other fields. Well, your old oil companies are about like spoiled kids, and that their favorite toy is their next toy. And so they would come out, they'd hit a well, they'd cut back flips, they'd drill 20, 30 wells around it over the next couple of years. Well, then they'd hit a well 5 miles away. They thought they produced all this oil, so they just pick up their whole operation and move. Well, how much oil did they leave behind? And that's just, I would love to say our philosophy is much more difficult than that, and we've created a new way to slice bread, but it's not. We stand on the shoulders of giants and get what they left behind. Now, the reason the Choctaw is unique When you find left behind reserves, typically you're going to need to drill 10, 15, maybe 20 wells to develop all the reserves, and then you got to go somewhere else. Then you're out of area to drill, so you got to find something else. Well, in this particular area, when we started going through it, we acquired all the land. Well, the first thing you do when you acquire the land is you want to gather all the data. Now, every time you drill a well, you run a log. When the well's finished drilling, you have open hole, you basically drop a geophone down there, it reads what you have, gives you permeability, porosity, resistivity, all kinds of data points. It tells you what's in your well.
Yeah.
Well, the amazing thing is a log from the 1940s gives you the basic same root data that a log from today does. Yes, our logs of today have more data points, and when we print them, they're prettier because our printers and computers are better. But the main root data, your permeability, your porosity, your resistivity, the main thing your geologists look for is the same. Well, all these logs are public information if you know where to look to find them.
Okay.
And so when we acquired all this land, our first mission, we gathered 40,000 different data sets and every log we could get our hands on associated with the wells drilled in this field. And what you want to do is you want to build a field profile. You want to see, okay, what's the average successful well out here do? So you look through the logs and like on this field, when you see a successful well, you're going to see multiple stacked pay sands. Basically, each pay sand is essentially a well unto itself. You produce them one at a time. A successful well will have anywhere from 3 to 7 different pay sands. And in total, have anywhere from 500,000 barrels to 1.5 million barrels of oil. And so you're going through these logs, you see a beautiful stacked pay sands, you pull the production report, 1 million barrels. Okay. Another one, beautiful stacked pay sands, pull the production report, 500,000 barrels. And so you build the profile. Well, then all of a sudden we'd see a log, looks just like the rest of it. Beautiful, multiple stacked pay sands, should have 500,000 to 1.5 million barrels of oil in it. Well, then when you pull the production report, you see 30,000 barrels. You go, I wonder why. So you earmark it and set it aside and keep going through. Well, then we saw another one. Beautiful stacked pay sands, but very little pay. When we were done going through all that data, we found several dozen of these wells. And once we did the research, we had to figure out, okay, why didn't these wells produce? They should have had a lot of oil in them. And what you found out, the guys had 2 problems. One, I don't know if it was ego. I don't know if it was their bosses. I don't know if it was just the time that they were drilling. Whenever they tried to produce these wells, they wanted to be the big dog on the block. They tried to produce as much and as hard and as fast as they can. Well, these wells, while you can do that, they're also going to produce sand. You hear about people saying they frack a well, okay? But when you frack a well, you've basically drilled into a very hard rock that has no channels that allow the oil to get to your drill pipe. So what you do is you take a cocktail, whatever's in your frack solution, you push it in that hole at high pressure, and you're busting it out into the formation. And what you're trying to do is bust that rock open and create channels where the oil can flow back to you. That's fracking. We are the exact opposite of that. Instead of drilling into a hard rock, we're essentially drilling into a beach. And so when you pull, think of it like this. You had a big gulp in front of you with crushed ice and Coke in it. No lid, and all you wanted to drink was that Coke. Well, you'd have to block the ice with your lips or your teeth and slowly, gently drink it just to get the Coke. Well, that's what we have to do on these wells. That's the exact opposite of what these guys did. They basically opened their mouth and just poured it in. So all of a sudden, they turn their well on. They pull it as hard as they can. They had great production levels, but then all of a sudden, a couple of weeks later, their beautiful oil well turns into a 5,000-foot column of cement.
Okay.
Well, at that point, there's nothing they can do. They had one of 2 choices. They can either stop and drill a brand new well, or they can walk. Most of them walked. Now, the difference between then and now we know how to deal with the sand. Okay. Now we know how to gravel pack the well. Now we know how to screen the well. Now we have techniques where we can keep that sand at bay. And so essentially what these guys did is they paid to research it. They paid to drill it. They paid to produce it. And then they just walked away and left it there for us.
But so what does it look like, RJ? Tell me about like in the inception of a deal like that. Where do you buy the land like that and all? And then is all this data and information comes along with the sale? I'm assuming. Like, what is your due diligence process? Prior to having to acquire.
Oh, it's quite.
What does it look like?
It's quite extensive.
I can imagine, yeah.
I mean, it really just, it varies in the area. It varies with the kinds of wells you're drilling. If you're trying to establish new production, a lot of this information was stuff we had to dig out. It wasn't just voluntarily given to us.
Mm-hmm.
We had to go dig it out. Now, you have certain sets of data that when you're trying to acquire a property, there's certain data that they have handy that just everybody shares. But no, you got to go through. You got to check the landowners. You got to check the mineral right owners. You have to make sure that the absolute worst thing you could do as an oil company is go out and drill a big well that you don't own. And so you got to make sure you have all that locked down before you even get out there. And I tell everybody that, look, when somebody makes an investment, when somebody takes their investment dollars and invest it with somebody, that's the most sacred decision you can make in business.
Sure.
Most people didn't get their money easy. Most people had to pay a price. They had to sacrifice. They had to miss Little League games. They had to miss ballet recitals. They had to miss dinner with the family. They had to do things that unsuccessful people won't do in order to get to where they're at. And so when they make that decision to write a check or to wire money and invest in you and your family, how dare you take that light? And so when it boils down to it, you have to make sure, first and foremost, before the economics, before anything else, you have to make sure that you're doing business with the kind of people you want to do business with. Can these people do what they say they're going to do? What does their track record say? Are they new in the business? How long have they been doing it? Now, I know past performance does not indicate future performance. I understand that. However, past performance does give you an idea of who you're dealing with.
Sure.
You know, I was sitting at a table with about 15 investors here, probably a year ago. And we were sitting here having a conversation about various programs, and there were a couple of syndicators in there. And so everybody was talking various deals. And one of them looked at me and said, well, what partnership have you put together that you're the most proud of? And it kind of stumped me. It was the first time anybody had ever asked me that question. And I looked at it and I said, honestly, you would think I would say it's the partnerships that work. But the fact of the matter is, when a partnership works, it did exactly what I thought it was going to do. How much pride can you get? Don't get me wrong. I take pride in them, but how much pride can you get in being right? It did what I thought it was going to do. I know. I said, so it's not those. I said, honestly, I truly believe it's the partnerships that didn't work and what we did to take care of those partnerships. Because that's the position we sit in. If I have a partnership that doesn't work and I'm in a position as a company where I can help it out, I'm going to help it out.
Sure.
Not to get anybody to invest.
Yeah, not everyone's going to do that. Yeah.
Yeah, not that. Well, I mean, they've already done their job. They had faith in me and my family. And so I'm going to do everything I can. Now, once we're in scramble mode, if the wells didn't work, and once I'm at the point where, okay, it's either a total loss or I'm going to do something, well, at that point, it's not trying to make you money. If I can make you money, great. It's trying to get you back to whole.
Yeah.
It's trying to put you in a position, okay, where at least it's a no harm, no foul. And the reason I do that, I mean, I've had people say you're crazy. I mean, why would you do that? They're never going to go, well, I didn't do it for them to investigate.
Yeah.
That's not why I'm doing it. I'm doing it because every night when I go to bed, right before I go to bed, the last thing I do is I look myself in the mirror. I've done it since I was 18 years old. And I want to know I'm happy with who I'm looking at.
Sure.
I mean, that's my check and balance, because you can't lie to yourself. And when you look yourself in the mirror, if you're not happy with who you're looking at, you've done something wrong. You better figure it out.
Well, you know, this podcast, the community behind it, Accredited Life, is all about that. You know what I mean? It's all about taking that life assessment and being able to look at yourself in the mirror and knowing that you had a good day's worth of work and you did all you could do, and you know, you learn from your mistakes and you celebrate your successes and things like that. So that's a powerful thing you're saying there. Kind of walk me. I want to talk more about the partnerships and what exactly they look like. But talk to me about the types of vendors and the type of people that you work with in order to drill and to do due diligence and things like that. Is it all done through your company in-house, or I'm assuming you're working with subcontractors and stuff like that in order to do certain things?
Yes, we have certain crews. You have your drilling crews. I mean, you have your completion crews. You have your dozer crews. I mean, you have various crews that you contract with, but that's one of the reasons we do everything from beginning to end. We operate the wells. We do it from, like I said, from beginning to end, because it's been my experience that Oh, and don't get me wrong, syndication is tremendous. But by definition, if you're syndicating, you're selling somebody else's deal. Well, most likely in business, if it's somebody else's deal, it's been stepped on before it got to you. And so that's one of the reasons we do it from the beginning. We want to give our partners as close to the bone as we can get them to save them as much money as we can. Whereas if I start selling somebody else's deal, chances are they've stepped on it for 10% before they even got it to me. And so not only do I have to cover the 10% that they stepped on, I can't do it for free. And so it makes the deals. And so that's one of the things I look at is, how many people have stepped on this deal before it got to you?
Sure.
Sure.
And that was came to mind with what you were saying. How many times has that piece of land changed hands before it's gotten to you? How many times has it been drilled? That kind of thing.
Honestly, that doesn't matter to me. How many times it's been drilled on is did they get what I'm looking for?
Okay.
Did they like on, and this is kind of getting in the weeds a little bit, but a salt dome is basically, not to be gross, but for lack of a better term, it's essentially Earth's pimple.
Okay.
And it's a big body of salt that comes from down deep and pushes up towards the surface. Well, eventually it hits a cap rock. Eventually it hits something it can't go through, but it'll mushroom. Well, on a salt dome, your low-hanging fruit, the area that you want to develop first, is right underneath the mushroom cap. It's called the overhang. And it's pretty much common knowledge in the salt dome world is that that's the first place you go. That's the high point. That's where most of your oil is going to be. And so when we acquired this property, we made the assumption that all of the overhang had already been developed. And so we were still good. We thought there were probably 20, 25 million barrels of oil sitting out here. Well, once we got that 40,000 set of data, all of a sudden we go, whoa, there could be 40, 50 million barrels of oil sitting out here. Once we saw all these wells that they had missed. Well, the last piece of the puzzle was the 3D seismic. Once we got the 3D seismic and laid it over the top of all of our stuff, all of a sudden we realized almost 70% of the overhang was untouched. Well, once you bake that into the recipe, all of a sudden we're sitting on potentially 100 million barrels because they left the low-hanging fruit. And so why did they leave it? I don't know. But I know this. There's not many oil companies that are interested in salt domes. And it's really because it's very difficult drilling. You have to have a certain level of expertise to drill these wells. And we do. And so that's really one of the reasons we like them is because we know how to drill them and lack of competition. But the other side of that is there's normally a lot of oil left on salt domes. You just have to know how to get it out.
So talk to me about what a partnership with an accredited investor looks like. Just kind of give me the overview. How much capital are they investing? How much return should they? I won't say expect, but like what projections and things like that. And then time frame and like just the capital stack too. Is it like how many investors are there typically, and are you utilizing debt in any way? Just kind of walk me through what a partnership looks like.
Okay, well, I would go ahead just to make note on what you said. I wouldn't utilize debt to invest in oil. Okay. This is oil, and only the good Lord above knows exactly what's down there. Regardless of what the geology says, regardless of what your track record says, something could happen. And so I'll start with that. But we run a Reg D 506C. That basically means every partner needs to be accredited. And our partners can invest as general partners or limited partners, so they can get the tax benefits against their active income or against passive income. Completely up to them. And typically it just varies on what we're doing as a company at that point. Like right now we're in a mode, the last handful of partnerships we run have been 2 well partnerships. And what the partners do is typically they'll put 100,000 in, some flush with cash will put in a couple 100,000, but typically $100,000 a position. We have a unit price at 100,000. And so just take you through a typical run. Okay. A partner invests, let's say right now, let's say October 1st. A partner puts their money in October 1st. Well, right off the bat, they know in 2024, they're going to get about a $30,000, $35,000 tax benefit out of that money. It's an above-line deduction. Once again, I'm not a CPA, I'm just giving you a general rule of thumb. You made 150, Uncle Sam looks at you like you owe him 150,000, and you put 100,000 in a drilling program, he'll look at you like you owe him 115,000 now. And so that's right off the bat. So October 1st, well, from the day you put your money in, let's say we start drilling November 1st. It'll typically take us probably 30 days per well. 2 well deal. We drill the first well in November, finish drilling it. December will take us to put it in production. It's selling oil come January. Now, the second well will come in, rig will move from the first well to the second well. So we start drilling it in December. January, we're putting it in production. February, it starts producing revenue. From that point, once it starts producing revenue, every quarter, you will receive your revenue statement and you'll receive your check. Now, what these wells, now, prime example, when it comes to what the revenue could be, it just depends on what the zone we're producing out of does. You will produce these wells from the bottom up. Best example to show you how it impacts a partnership. We just finished drilling a well. We had 8 different pay sands in it. The best pay sand in that well on the logs is the 4th from the bottom. We have 3 zones below it. Well, if we don't produce those 3 zones now, we won't go back down and get them later. It's just too hard. You risk losing the well by going back down. Well, when our partners hired us, they hired us to make them the most money we could make. If I just wanted to churn them and sell them again, I'd have gone straight to that big zone. I'd have popped the big zone, and we'd have forgot those bottom 3 zones because that zone's probably going to produce for 5-10 years, and they just forgot about it. Well, that's not what they hired me for. They hired me to make them the most money. And the way to do that is to go to those smaller zones first and produce them, like I said, because we won't go back down later. Okay. Now, the benefit to them that they're not going to see for another 10, 15 years, well, we produce the bottom zone, go to the next one, go to the next one. So let's say they made 2-to-1 over the next 10, 12 years producing those 3 zones. All of a sudden, we go to that big zone and hit it 10, 15 years from now. It comes at, well, what are oil prices going to be 10, 15 years from now? Has a pretty good shot they're going to be up.
Sure.
So all of a sudden, you have a chance at making 100% on your money annually 15 years after you originally made the investment.
Wow.
And so so it's just one that depends on what zone you're producing from to what your rates will be. But right now, we have 5 partnerships in this field. The smallest partnership is averaging about 5-10% annually. The biggest one is averaging about 40-45% annually. Overall, when it comes to projections on what the partnership should do, of the 5 in the field, one of them be probably 2-to-1, 3-to-1. 3 of them will be anywhere from 4 to 6-to-1 on their at-risk money, and one of them has a good shot of being about 10-12-1 on their money. Wow. And so, I mean, we're sitting in a pretty good spot. On average, I'll probably average about 4 or 5, maybe 6-to-1 on the money. But like I said, all we're doing is cookie cutting. We're going next to proven production and drilling another well. And so I truly believe our biggest risk on these is the actual mechanical nature of drilling. Like I said, we drilled 11 wells in this field, partnership wells. We placed 10 of them into production. The one well we missed, we found a well on it. We just got hung on the hole. Well, once we figure out how to get past that little hang, well, we know the oil's already there. And so it's just putting our partners in a position that not many people can.
That's amazing. So what's the life cycle for an investor like? Like, how long should they expect the investment to be?
Oh, God. Minimum 10, 15 years.
Okay.
Maximum, we have some wells out here that we've already hit that'll produce for 40 years.
Wow.
It's that one I was just telling you about. There's 8 different pay sands, 322 feet of pay in that well. If each one of those pay sands on average will last 3 to 5 years, well, if each one of them lasts 5 years, that well's going to produce for the next 40 years. Wow. And that's the partner's remember. We call it rocket share money.
Yeah, at that point, that definitely, yeah. Yeah. Now, what do you do when it's like? How does it end? I mean, like from could you run out eventually at a certain site, and now do you sell that land, or like what does that look like? What's the exit look like?
No, at that point you just walk away. I mean, at that point now you have plug-in liabilities. I mean, you have some environmental responsibilities that we have to take care of, but we do that side of it. But when the wells cost more to produce them than they're actually producing, is when those zones are open. And when the last zone in the well is done producing, then it's done. We send out the final K1 and we close the partnership.
Okay. Wow. Well, I could talk to you all day. There's so many different parts and so many questions have come up, and I'd love to continue this conversation, but I think for the effort of time, we should end it there. And I'd love to have you back on sometime, or I'd love you to come to the community, and maybe we can do a webinar together and get more into the nitty gritty. Just fascinating conversation. Like you said, I do see a lot of similarities when it comes to, especially what we do with workforce housing and all, like this, the supply and the demand, some of the political kind of pressures and things like that. So it seems like this does provide some great diversification for investors, some really unique tax opportunities and things like that. For somebody who wanted to learn more, how can they get in touch with you, RJ?
Oh, easy. You can email me, RJ Burr at panex.us. We actually created a website, panex.us/learn, that was specifically designed for individuals who've never invested in oil. It gives you just a base root foundational knowledge of oil. Or Oil and Gas 101 just kind of gives you an overview of the industry. Oil and Gas 102 kind of breaks down the tax benefits for you. This is your money we're talking about. We want you to be 100% comfortable with who we are, what we're doing. And I tell my guys, look, it doesn't matter to me if it's the little hair on your pinky toe. If the little hair on your pinky toe has a question and you don't ask it, shame on you. That's what we're here for. We want to make sure that every question is answered because, like I said, this is a short-term deal. I don't want a partner to invest with me one time and never invest again. I want a partner that's with me for the next 50 years and lets me make the money. Let the oil and gas industry do for you what it's done for so many other people.
Awesome. Well, I was on your site. It's very, very sharp and great information, easy to navigate. And I'm sure investors will have a lot of questions when it comes to this. I know I have more, so I'd love to continue the conversation with you. But for now, thank you very much, RJ. It was a pleasure having you on, and I hope to have you back soon.